The warning lights are flashing across the crypto market. Bitcoin has officially confirmed a short-term bearish breakdown after weeks of subtle signals on higher timeframes. The momentum that carried prices to repeated highs through 2024 has slowed, and traders who once called every dip a buying opportunity are suddenly cautious. In today's update, we'll talk through what this means for Bitcoin's next targets, how I'm adjusting my trading approach, and what's happening to Ethereum, XRP, Solana, and Chainlink as the correction spreads through the altcoin sector. The idea here is simple: understand the data, prepare for volatility, and stay ahead of the crowd rather than chasing the move after it happens. Bitcoin's weekly chart still shows the macro uptrend that began in early 2023, but the strength behind that move is fading. The supertrend indicator remains green for now, meaning the broader bull market is technically alive. The problem is that price is now hovering just above the zone that would flip that signal red for the first time since the 2022 bear market. That threshold sits around $96,000. A confirmed weekly close beneath it would formally start a new bearish phase. Until then, Bitcoin is in what you might call a transitional zone. Bullish structure intact, but confidence slipping fast. Each long-term run in Bitcoin includes multiple deep pullbacks that shake out late buyers. The August 2024 dip briefly broke the supertrend before price recovered. Many traders called the bull market over then, but the market bounced and printed new highs months later. That history is worth remembering now. We're not necessarily at the end of the cycle, but we are likely entering a corrective stage that could last weeks or even months. Zooming into the daily chart, the pattern looks clearer. Bitcoin has faced repeated rejection at just under $111,000. Strong resistance that once served as support. Every test of that level brings heavy selling pressure. After the most recent rejection, price dropped through 106 to 107,000 support, and momentum accelerated downward. Once that zone failed, the next obvious magnet was the psychological 100,000 level, and the market is now approaching it quickly. If 100,000 holds, traders may see a temporary bounce. If not, chart structure points toward 97,000 as the next area of demand, followed by $93,000 to $94,000. A deeper washout could reach the large liquidity pool visible on the liquidation heat map near $89,000. These are not predictions, just data-driven regions where buying interest or liquidations are likely to appear. Technically, the short-term structure completed a head and shoulders pattern with a neckline around 106,000. Once price closed below that level, the pattern activated and produced a measured target around 99,000. That means the short-term drop we're witnessing is consistent with the textbook projection. In my own portfolio, I've moved into a hedged position. On one account, I'm running a grid bot that automatically buys in small increments as price drops and sells small portions as price rises. This bot works well during sideways markets because it profits from volatility rather than direction. The weakness of this method is a sharp, one-directional fall. The bot keeps buying as price declines, leading to an unrealized drawdown. To balance that, I've opened a modest short position on a separate futures account. The short roughly offsets the Bitcoin exposure of the grid bot. If price keeps falling, the short gains value and covers the unrealized losses of the bot. If price stabilizes or bounces, the bot begins locking in small profits while I can gradually close the hedge. The idea is to stay delta neutral, meaning overall exposure to price direction is limited while volatility still produces profit opportunities. This kind of structure is far safer than an all-in long or short during uncertain markets. It's not financial advice, just an example of how to manage risk when the market turns unpredictable. Looking again at broader market metrics, liquidity is heavily concentrated below the current price. The same pattern appeared in past corrections when large players targeted lower zones to trigger liquidations before accumulating again. That's why the 93 to 89,000 range must be watched closely. If the sell-off accelerates, that's where the market could flush out weak hands before attempting recovery. The altcoin market is following Bitcoin's lead almost perfectly. Ethereum, which had held up relatively well earlier in the year, is now testing a critical zone between $3,350 and $3,450. That area has served as both support and resistance in past cycles. A decisive daily close below roughly 3,350 would confirm a breakdown from the recent range and expose 2,700 to 2,850 as the next strong support band. Ethereum's structure on the 3-day chart already shows a series of lower highs and lower lows, a clean downtrend forming inside what used to be a bullish channel. The brief bullish divergence that appeared weeks ago, where the RSI rose slightly while price continued lower, only produced short-term sideways movement. It did not reverse the trend. That's typical behavior in a declining market. Divergences offer small relief rallies, not trend changes. Unless Ethereum can quickly reclaim and hold above 3,450, the path of least resistance remains down. Solana is facing the same pressure. After multiple rejections from the $190 to $200 zone, price has broken below 170 and 157, erasing months of gradual gains. The next technical supports appear between $143 and $146, with deeper zones near $135 and $125 if Bitcoin's decline drags the entire sector lower. Solana's on-chain activity remains strong, but traders care about liquidity first. And right now, liquidity is leaving altcoins in favor of Bitcoin or stablecoins. XRP continues to act as one of the weakest large-cap coins. The long-term bearish divergence on its weekly RSI started months ago and is still unfolding. The coin has now slipped below short-term support between $2.30 and $2.40. If this daily close holds under $2.30 and XRP fails to reclaim it, that area flips into resistance, leaving the next visible demand region closer to $2.05 or even $1.90 on extended weakness. There are hints of a small developing bullish divergence on shorter timeframes, but like Ethereum's earlier example, that would likely produce only a minor bounce, not a full reversal. Chainlink has also rolled over. After defending $16.50 for several weeks, price broke below that level and the key Fibonacci retracement zone between $15.20 and $15.70. The next notable support sits near $13.30 to $13.40. Should a bounce occur, those broken levels around $15.50 will probably act as resistance. Altcoin weakness is confirmed by the Bitcoin Dominance Index, which recently reached the 60.5 to 61% range. Historically, when dominance climbs, altcoins lose ground. Right now, dominance is stalling at resistance, giving altcoins temporary relief. If dominance rejects here and trends slightly down, altcoins might stabilize relative to Bitcoin, even if prices in dollars remain soft. But if dominance breaks above 61% and holds, altcoins will almost certainly underperform Bitcoin more severely, extending their drawdowns. So, where does this leave us? The overall message from every chart is consistent. Bitcoin has entered a corrective phase. The macro bull structure is not destroyed yet, but momentum is fading and short-term price targets around 99 to 100,000 are nearly fulfilled. If those levels fail to hold, 97,000 and 93 to 94,000 come next, followed by the deep liquidity pocket around 89,000. Those zones could form the base of the next accumulation phase if sellers exhaust themselves there. On the other hand, if Bitcoin rebounds strongly from 100,000 and reclaims 106 to 107,000 as support, it would signal that buyers are regaining control, potentially setting up a new attempt toward 111,000 and beyond. Altcoins will continue to mirror Bitcoin's tone. Ethereum's critical threshold is 3,350. Solana must defend 143 to 146. XRP and Chainlink both need to recover their broken supports before sentiment improves. Until those conditions appear, this remains a defensive market. For traders, capital protection now matters more than chasing upside. Avoid excessive leverage, use clear stop levels, and size positions modestly. If you're using automated systems like grid bots, consider partial hedges or smaller grids to limit drawdowns during one-directional moves. These markets can remain volatile far longer than most expect. Sideways phases with quick spikes up and down are likely through the next several weeks. From a macroeconomic view, global liquidity and central bank policy remain key external factors. If the Federal Reserve or other major banks begin cutting rates or signaling softer policy, risk assets could stabilize. If inflation surprises to the upside or yields rise again, liquidity could tighten further, pressuring crypto markets more. In the short-term technical picture shows weakness, but the long-term narrative for Bitcoin hasn't vanished. The same cyclical rhythm that brought every past correction will likely bring another recovery later. Between now and then, discipline is what matters. Respect the levels, keep risk defined, and don't assume every dip is the bottom. The charts are giving us clear information. The market is tired, momentum has shifted, and caution is the best strategy until proven otherwise. If you found this breakdown helpful, remember to subscribe so you don't miss the next update when these support levels are tested. The coming weeks will define whether this is a deep correction or the start of a larger reversal, and I'll continue tracking every major move here. Stay alert, manage risk, and trade safely.